It's interesting, the idea of the Fed perhaps having to slam on the brakes to hasten, more rate cuts before perhaps the economy is ready for them or the markets are ready for them. It sort of assumes that there is a pain threshold for the Fed, that there's not a new framework that's going to let them be more tolerant of higher levels of inflation than there have been in the past. Is that something that, you think is open for question?
So I think the pain is there. I think when they look at a CPI is 6.8%, when they look at people saying that the core PC is going to go up, when they look at the possibility of a 7 handle, and this has become a political issue as well as an economic, social, and financial issue, the pain is already there. So they are having to play massive catch up. And the question is, at what point do they lose their nerve? I don't know what the answer is. I think the marketplace assumes they're going to get it just right. And the Fed has been incredibly supportive of markets. So the conditioning of the marketplace is to assume that the Fed will get it right. But economists will tell you that it is not a dominant probability. This is going to be really tough. The Fed has exchanged 70 record highs and the third year of double-digit return for the marketplace for a much more difficult 2022 policy outlook.
Does the way the bond market has absorbed this likelihood of not just a higher inflation for longer, so far anyway, but also perhaps 3 Fed rate hikes or more, in certain scenarios this year, does it tell you anything about, the market's ability to be resilient in the face of this? We have a flattening yield curve to some degree, but we obviously have not seen the kind of inflation panic running through the bond market.
We haven't, and that's because the Fed continues to buy, and we're not going to really see the genuine response of the bond market till the Fed stops its purchases. And that's going to happen in the first quarter of the year. But you've already had the sense in the bond market of let's keep an eye out for the policy mistake. You referred to it, it's been the flattening of the curve. So we have priced in quite a path for interest rate hikes, but further out the curve, we've also priced in concern about demand. So the bond market senses it, but it's not fully pricing in it yet because the purchases are so dominant right now.
What are the implications for the rest of the world here? If you just look at how markets have behaved, obviously Asia and emerging markets generally had a weak 2021, a lot of noise about, COVID restrictions and things like that and supply chain issues. Europe's done OK, but what would it mean if if the Fed is going to be kind of leading the way in tightening policy or having less easy policy?
And that's critical, Mike, because if you look purely at valuation, as some people are doing, you are very tempted to rotate out of the US and Europe into emerging markets and China. That's what you would do if you were valuation focused. However, if the Fed is in play and if the Fed can end up with a policy error, you really don't want to do that. Because we know that when the US sneezes, the emerging world catches cold. Now, add on top of that what you mentioned, the zero COVID policy, which is going to be very difficult to maintain in China. I myself would not fade the US and Europe in favor of emerging markets and China because I am worried about the policy error. And I'm also worried about what zero COVID policy means for economic activity in China. But some other people, Mike, are advocating. They advocated it last year, they advocated the year before, and it didn't work out in either year.